So it was very interesting to listen to this particular presentation just before because it kind of fed into some of the issues I wanted to touch on, specifically around the whole idea of fiduciary capitalism, because what it really expects, or I suppose the theory that it perpetuates, is the idea of this universal ownership that institutional investors have. And part of that, as part of their fiduciary duty, and with this idea of capitalism, is that they use their power and their responsibilities to change the market. And one of the ways that they do it, well, the theory really just suggests three ways to do it, which is active ownership, which essentially meaning you're not just buying institutional instruments like equity and just leaving it there. You're actually being more active in forcing your corporates that you are putting money into to behave better from a social or environmental perspective and in governance. And another thing is around the due diligence. So essentially it advocates that through due diligence you have a way of better understanding the investments that you are making and understanding that those investments do have a social or environmental impact. He described it as just externalities, where other people just don't view it as just externalities. And one of the questions is really around how do you then internalize those externalities? So again, we're looking to the fund managers to say, yes, you're putting your money here and there and everywhere. And firstly, do you actually know who you're putting your money into and what kind of risks come with that? And how do you then internalize these externalities? Or how do you force these companies to internalize these externalities? So with this particular topic, with this just transition, I think one of the difficulties is that there's an expectation for this just transition in an economy and a market that's also in transition. And just to give you a brief background, it's basically looking at the history of the South African pension fund. When the first pension funds were registered in 1958, when the Pension Funds Act was introduced, you had about 2,700 pension funds. And then you had huge growth, exponential growth of the number of pension funds in the industry, where they peaked to about 16,000 pension funds in South Africa only by the end of the 90s. And then there's been a huge drive, especially from the regulator, to then consolidate the market. So say, a lot of these pension funds are not very active. You have boards that don't even meet. You have, they're not necessarily giving what the members really need. So you need to now consolidate that. And quite a lot of regulation came about to drive that, and you saw this, it's still happening, but you've seen that it's consolidated so much that you have, the last I checked, there were about 1,600 active pension funds in South Africa now. So now it's 10% of what it was at its peak. So what does this mean? It essentially means that you have more pension funds which are larger, and larger from an assets under management perspective. And that brings into discussion the idea of the power that they have. And I think that is where I think a lot of friction then happens, to say there's an expectation that, yes, you have fewer and larger pension funds who have the power to drive certain changes within the markets, especially from an environmental perspective or social perspective. In this instance, we're really talking about climate change. But I really like the one of your closing points that there's there is a need to focus, not to be too focused on climate change only, but at the detriment of other things that are also quite important to that market. And I think I'll touch on that in terms of even just the history and what the narrative has been, especially around the introduction of Regulation 28, which essentially replaced the prescribed assets when it was introduced in 1989. And I know that is also a contentious issue that is now coming back into debate, to say, do we actually need to have prescribed assets? Prescribed assets did have value from a developmental perspective, and when you saw the kind of prescribed institutions, so it wasn't just government bonds, there were institutions that exist today that benefited from this prescribed assets. I mean, when you look at the JSE was one of the prescribed institutions when you look at the registrar's reports. So I think sometimes, and the water boards and all of those, they were actually beneficial. They benefited from prescribed assets. So I think when that debate happens, it also needs to be, I think, kind of done it from a more genuine or more authentic perspective or more balanced perspective, because quite frankly, the people who've been making the biggest noise against prescribed assets have been mostly fund managers. Maybe it's because they have the mic, I don't know. But then you really want to say that, if there is a better way to do prescribed assets, we don't have to say 53% of your assets need to go to bonds or that are government bonds. How else can we then do it? And then start to have an industry or a market that can channel money towards a transition, a just transition. So there's a lot of power, obviously, that comes with the money that these pension funds have. And so what are then the challenges or the structural issues to be addressed in facilitating this just transition? And I had a few thoughts in terms of things that I wanted to highlight in terms of, yes, you have this idea that, yes, you have all these funds, they have all this power, and you have trustees who can actually drive things, but from a pragmatic or practical perspective, how does this work, and where are the bottlenecks or the blockages, and how can then the industry as a whole play a better part in this just transition? That's why when you ask, is it about pension funds? Not only pension funds, but more of the ecosystem. So what has been, well, in my former life as an investment consultant, it was quite interesting to note how there's been a retailization of institutional investors. So essentially, there was a huge drive from asset managers to actually get pension funds to go into their retail portfolios. So you have those that go into pooled portfolios, which are also like collective investment schemes, but you also started having institutional unit trusts being introduced. And I mean, that's kind of cost effective for an asset manager because, reporting is very easy. They have one portfolio. You don't have too many segregated mandates and various demands from pension funds. So quite a lot of these asset managers increase the amount that you would actually need to have a segregated mandate as a pension fund. I know there are some fund managers here. I don't want to put them on the spot and ask them what their minimum is right now. But this has been increasing quite dramatically. So what does this mean from a practical perspective? Like you say, he has a board of trustees who's supposed to be active as an investor and make sure that they, put together policies and give mandates to pension fund asset managers to address whatever social or environmental issue. So what this has meant is that their hands are tied. So you have all this money, but if you want to go into a pool mandate and they demand R500 million as a minimum for you to get a segregated mandate as an asset manager, as a pension fund. If that is your size, some funds are not even the size of R500 million. And some of them are the size, but you can't then, in the interest of diversification, only give one mandate to one asset manager. So from a structural perspective, then it really does pose a challenge. And how do you then exercise that power? So you do have that potential power that you mentioned, but from a pragmatic perspective, it becomes very difficult for a pension fund to be able to then be active and go and engage because they go into these pooled arrangements that are linked to insurance policies, and they're actually not even the beneficial owners of the assets. So from when you go to the custodians where there's a register of who's the shareholder, when you go there, it will be Ellen Gray Insurance Company or Mutual Insurance Company. So you're finding a lot of that. So really, the trustees, as much as they have this potential power, from a structural perspective, they're also disempowered in terms of addressing some of these issues. But let's not only focus on asset managers, because in some instances you do have fund pension funds who do have that ability to go into segregated mandates or do have segregated mandates, but they're not necessarily using them to demand certain mandates from asset managers. So on that, on the other end, you also have an instance of complacency from that perspective. And then you also then wonder, why wouldn't then the pension funds actually make use of this opportunity? And I mean, this really, again, I think speaks to, how are we structured as pension fund boards. Not everyone is actually a full-time pension fund trustee, and really there are issues around even information asymmetry. For you to know the issues around first strand and the disclosure, if you are, it's not even just saying you're a shop steward or just an admin or a manager. Where are you getting this information, and can you actually then take this information and use it to engage these companies to become better corporate citizens? So I think that, and what's quite ironic in terms of even the development is that when you look at, for example, the cost, because one of the things that pension funds trustees need to be very diligent around is the effective, how cost effectively they're running the fund. And quite often they really target the fees of the asset managers to say, how do we then make these fees? How do we lower these fees? And quite often you had a difference between what a pension fund would pay for a segregated mandate compared to what they paid for a pooled mandate. But now I was reading the Forbes annual retirement fund survey, and the fee section, it was quite interesting to note how there's been a convergence in terms of the amount of fees that you pay in a pooled portfolio versus what you pay in a segregated mandate. So even though you still have this idea that pension funds must also cut their costs, sometimes the argument around costs is no longer a valid reason for not actually firstly demanding a segregated mandate, but also then using that ability of the segregated mandate to be more active and to drive change through your shareholder activism. And one of the things that I also then wanted to touch on was really around shifting of focus towards impact investment. So I think this has been a very interesting observation, and to see how then, how does this actually then play into the powers and responsibilities. And one of the things that I've been noticing, when part of my research for my own PhD, I would sit with some of the pension funds and just listen to some of the conversations, and it's been interesting. And even as a consultant, when I was sitting in these meetings, it was quite clear that there was a desire by pension fund trustees to have investments that generate an impact, and they wanted to be able to show that impact to their members. And quite often, when you then look at what is happening, is that you find that they kind of get, they curb the enthusiasm in a way and said, actually, maybe this is not the most cost-effective way for us to do it. So if a pension fund with a constituency in the Northwest or in Lesotho or wherever, they wanted to have investments that have an impact, you would have the comeback from the market saying, this is not necessarily what we can deliver for you. And I think that's also a lost opportunity in terms of, yes, there is power that these pension funds have, but how much power are you actually exerting to get the market to produce the products that you want? And what has been quite clear is that the market, especially the demand side, the pension funds have been just product takers or product buyers, more than pushers of particular products that they want that would speak to what they need from an environmental or social perspective. And I think that power relation needs to be relooked, and to say, if you are a service provider, an asset manager, and I want you to create a product for my people and for my constituency, you will do it, otherwise I'll go elsewhere. And I think if we can get that, I think then you'd be able to have that kind of facilitation of a transition to say, we want our investments to make sure that they do benefit our people and the immediate environment, and can have a larger social impact. And another issue then is around the great expectations of the regulation. Sorry, did I touch an area? And I think that's always been, that's always the kind of go-to, debate around regulators. We need more guidance from regulation. We need, more leadership from Treasury or the financial services regulator. And I think that is a lost opportunity in the sense, or not lost opportunity, but I think it may be a bit too myopic in terms of even understanding what a policymaker is, or who the policymaker is, not what, who the policymaker is, because you can have policy that is at a macro level, but at the end of the day, all these pension funds as organizations also are policymakers for their particular assets. And I'm gonna wrap. So I think it's quite important to also then think about how do you then not only rely on policy and say, oh, maybe the government should instill this prescribed assets regime, when you can actually, as a board of trustees, you decide you can be the one who does prescribed assets for your set of assets. And I think this is something that can be explored further, and I think it would be nice to actually have that debate to say, how do you then shift the industry to become a bit more focused on the policies that they can make? Because when you look at this lovely document that we have from Just Share, a lot of it has to do with the things I touched on, to say, you need to pursue active stewardship, but how do you do it when you contractually or structurally your hands are tied? But you also need to develop your own policies, and those policies can happen at fund level, not necessarily relying on the government to say this is what needs to happen. So just in closing, I definitely think I think I really agree with, and I like the idea that was, the narrative that was in the previous presentation, which is really around ideas and power, because this is what actually would then move an industry or a market and even an economy to achieve what it wants. So you do have ideologies, and we need to be quite cognizant about what ideas are being fed or what ideas exist within our market around what pension funds exist for, what pension fund trustees should be doing, and how they should be doing it. And how do you then move from that idea to using whatever organizational power or levers that you have to then drive and drive this just transition. So this is where I'll close off, but I really look forward to just hearing where the conversation can go, because it really is important to understand that this is around ideas and power.